look at the daily interbank FX rates from the Bank of Ghana. We'll talk a little bit more about the Cedi in the course of the bulletin. But Africa's biggest bank, Standard Bank, has slashed Ghana's growth rate forecast for this year to 3.1% from the initial 6.2%. It has also lowered 2023 growth forecast to 4.1% from the earlier 6.8%. Government in the 2022 mid-year budget review cut the growth rate for this year to 3.7% from the earlier projection of 5.8%. Charles Lixnebua looks through the bank's latest research on Ghana and has more in this report.
The report said growth now faces a confluence of downside risk this year and next year. First, the government is running out of external financing options, therefore public investment in infrastructure is unlikely to underpin growth over the coming year. Secondly, the Cedi's fall since January this year has further increased inflation, which will soften private household consumption over the coming year. Therefore, Standard Bank said the Bank of Ghana's Monetary Policy Committee may have to further raise the key benchmark rate to stem rising inflation expectations as well as support the Cedi. Thus, it said may also further reduce private investment over the coming year. It also pointed out that the country's growth rate also faces rising domestic fuel prices and with no fuel subsidies to offer any support. However, the gold sector may offer some upside to the outlook. The Ghanaian economy expanded by 3.3% in the first half of this year.
All right, so this assessment of our economy coming after ratings agency S&P Global revised Ghana's ratings from CCC plus with the country's creditworthiness cut to junk status. Now, we're previously at B-. It also reviewed the country's economic outlook to negative, reflecting Ghana's limited commercial financing options and constrained external and fiscal buffers. Big English. Joining us to simplify them, partner at Deloitte Ghana, Yao Latte, to make sense of these assessments. And Yao, it doesn't look good for our economy, does it? And it's reason we must speed up negotiations with the IMF to restore some credibility to our economy.
Yeah, so good afternoon and thank you very much. And I think, like you rightly said, there's now a course to accelerate our program with the IMF. So if there is anything like an accelerated IMF program, Ghana should sign on to that as soon as possible. The reason is, if you look at what other African countries have been able to do, which have really helped them post-COVID, and they've actually recovered from post-COVID challenges. Zambia is a very good example. Zambia reached an IMF staff agreement, and as a result of reaching an IMF staff agreement, they've been able to engage with their external creditors and lenders and restructure their debt. Remember last year, Ghana and Zambia, among other African countries, were rated as countries at the risk or at the high risk of debt distress. Today, Ghana is rated as second among the country, about 30 countries, at the high risk of debt default. Out of the 30 countries, Zambia is not on that list. So it means that Zambia have been able to do something following the IMF staff agreement and have actually benefited from that IMF staff agreement. So what's important now is for government to accelerate the discussion. We understand that some agreements will be reached next week, and we pray and hope that that will happen, because what that would mean is that it will send positive signals to the investor community. The challenge we are having now is in two fronts. So we have limited access to external financing because you are not able to go to the international market to borrow. And also on our domestic funds, some of the investors have pulled out of our market because of the risk. And so having or reaching an IMF agreement will send positive signals, and you will have some of the confidence that investors had before coming back. So it's important that we reach an IMF agreement as soon as possible so that we get some policy credibility going forward.
And well, in the meantime, and like you point out, it's going to be difficult for government to secure external financing given this latest downgrade. Our revenue measures are not yielding results as we expected. I don't want to mention the e-levy, but obviously, what are the managers of the economy up against? And in the interim, what can they do?
Yeah, so I think that's very important. And it's just a downgrade from a situation that was worse to a worsening situation, to say. So you know that the rating, to just put in simple terms, you start from an A plus to a triple A all the way to a C or D, depending on which rating agency you are talking about. So whereas we were some time ago in the B column and today we've been downgraded further to a C, when we got downgraded to a B minus, some of the factors that were rated by the rating agencies are still staring at us in the face. So we've not been able to get around some of those factors. So I'll mention those the 4 factors. So the first one was the slowdown in fiscal consolidation as a result of the widening budget deficit. The second was our low revenue base. The third was our high public debt. And the last one was the fact that the government today does not have a clear majority in parliament. So ask me, out of these 4 factors that were mentioned, the first downgrade of Ghana, like a year ago, have we been able to resolve all these issues? I think one of them we attempted to, and being the low revenue base, we attempted to resolve that issue or solve that problem with 11. Unfortunately, that has failed, and that has not yielded the needed result. So that means that from where you are, from your B minus, you get downgraded further to a C because you have not been able to solve the problem.
I think Yao is frozen. We'll try and get him back on to continue with his point. But we have reaction from government expressing disappointment by ratings agency S&P's decision to downgrade Ghana despite the bold policies implemented to address macro fiscal challenges and debt sustainability, which have been significantly exacerbated by the impact of these global external shocks on the economy. Like you see on your screen, the statement says, government will continue to be proactive in addressing the impact of these external and domestic headwinds on the economy and on the lives and livelihoods of Ghanaians. Quote, government has implemented key revenue and expenditure measures, including the 30% cut in discretionary expenditure. The delays in the passage of key revenue measures introduced in the 2022 budget affected revenue performance in the first half of the year. However, all the revenue measures introduced in the 2022 budget, including the review of the MDA fees and charges bill and the tax exemption bill, the e-levy bill, have all now been promulgated by Parliament. These fiscal measures are now in full implementation mode to support our fiscal and debt sustainability policies, according to the statement. And so that's the Finance Ministry's reaction to the S&P downgrade, saying that they are disappointed, really, and they are confident that recent policies announced by the government would help bring the economy right back on track. And so perhaps we may get like Yalati later on in the bulletin, but we continue with another worrying trend. The Ghana Traders of Union Association urging government to reconvene the Foreign Exchange Committee set up a few years ago by the Finance Ministry, which involved all relevant stakeholders to help find an immediate solution to the depreciation of the cedi. According to the biggest trading group in the country, the depreciation of the cedi and the high lending rate is impacting negatively on businesses. In a statement, it said working capital of members has depleted by 40% since the dollar traded at 6 cedis, 40 pesos in December last year, but now going for almost 9 cedis. Yes, President of GUTA, Joseph Obeng, who spoke earlier.
Now the dollar is 9.1. We are yet to do our Christmas sales, and it means that shortly we are going to go for 10 Ghana cedis for $1. It means that one have to go and fund 1 million Ghana cedis to buy only $100,000. The picture is not very good for us. And like you said, we admit the fact that we are also part of it, the excessive importation and that we do. It's true. The demand outstrips that of the supply. Yes, but then there's a solution to this. The imports that we do cumulatively by the indigents is around 15% only. The import that the people in Kumasi, people in Accra, people in Tamale, and all that, the importers that we do volume-wise, we do only 15% of the total volume of imports that we do, and the rest is by the multinationals. And so then government, if it has intention to curtail importation or suppress importation, then government have to use investment laws to make sure that it tightens up the rate, the speed at which we import.
Derek Mensah, head of client coverage, IC Group, joins us to discuss this. Grateful to have you on the program, Derek. Well, we know that a major contributor to the Cedi's fall is the fact that we import so much. So at least govt admits they are part of the challenge, but says much of the blame should be on multinationals. Where does the blame lie, Derek?
I think the blame is for all of us to share, largely because we've been an import-dependent nation for quite a bit. But the situation has become very exacerbated, mainly because of global economic factors and also what the issue is on our market. One of these issues is the repatriation of dollars. So if you're looking at it from an investment point of view, where my industry is, you realize that there are a lot of foreign investors who are selling their bonds and looking to repatriate. They are no longer rolling over their investments and are seeking to exit Ghana entirely. This is putting a lot of pressure on the cedi. Likewise, the COVID-19 situation, supply chain disruptions have also caused a lot of multinationals to front load their, let's say, capital expenditure needs. So importation that would have been spread across maybe 3 or 4 months, they are doing it all and bulking it all in one go, thereby putting a lot of pressure on the cedi as well, as they look for dollars to import. So all of these factors have culminated into what we are today. On top of it, when you look at it from an economic point of view, you realize that the deficit situation in Ghana is much wider than a lot of analysts anticipated. We expected revenue to kick in. We expected expenditure cuts to also be better than what it has been. But unfortunately, we have seen the deficit widen larger than we expected. And as a result, if you look at all these factors, the main part in the economic cycle or in the economic indicators that will blow out when we see all these factors has to do with your currency. And at the moment, what we are experiencing is a combination of all of these factors, from the global perspective, from the local perspective, and also the pressure that we are facing from investors repatriating their investments.
And while we look at short-term fixes, govt is calling for a foreign exchange committee to be reconvened. How does that help?
Well, at this point, any form of help that the government or Ghanaians need, I think that we should look at it. But I feel that the situation, we fully, or the managers of the economy fully understand the issues that are facing the economy or the currency at the moment. I think they put in place certain measures to help improve or turn the tide. I think they are short-term in nature, but they may provide some form of respite. One of which, or two of those, are the syndicated loan that we are expecting somewhere in Q3, Q4. There's also the Afrexim loan that has been approved. We feel that even though capital markets have been closed to Ghana because of all the things that we are facing and the high interest rates in foreign markets, these two other levers that the government has yanked could potentially release somewhere close to about $2 billion onto the market. Unfortunately, these things are not going to happen, or the inflow is not coming in immediately. They are likely to come in perhaps towards the tail end of Q3 and Q4, and that's when we may see some improvement. But for now, I think that we may have to weather the storm, and hopefully when the IMF come out, or we do go into a program and there are concrete steps on how we are dealing with the fiscal situation, it may raise some of the pressure off the cedi ahead of the Q4 inflows that will be coming.
And Standard Bank, in its assessment of Ghana's economy, raised issues with the local currency as well. As you know, year-to-date depreciation to the dollar is pegged at 20.5%. Standard Bank suggests that the Monetary Policy Committee of the Bank of Ghana has to further raise the key benchmark rate to stem rising inflation. What do you think about that?
I hold a slightly different view. Not completely different, but my view is that when it comes to the currency, the issue is on the liquidity side. I understand that what the Standard Bank is saying is that if we increase the MPR, we are reining in the liquidity, and therefore the impact is that we will see a bit of a currency improvement. But the situation that we are in, if we want to see anything material in the market, we need to improve the supply side. So, as I said, a few of the things that government has to do, they've already engaged. The key thing is being able to have access to having the inflows coming quickly than we envisage. Hopefully, if the IMF program is accelerated and we are able to know exactly how much we may be able to access as balance of payment support, that may put the pressure or may relieve the pressure. For instance, you might find a lot more foreign investors deciding to maintain their holdings in government bonds and therefore not looking for dollars to repatriate their funds back. So that might lift a bit of the pressure off the Cedi. But at the moment, I feel that any further interest rate rise might not materially impact the Cedi in the short term. Perhaps for the next 6 months, it may filter through, but immediate response is a liquidity issue and not an interest rate manipulation issue.
And it appears much is dependent on an IMF program. Final question, what's your outlook? Good fears we may get to 10 cedis to the dollar by December?
Well, it's a crystal ball kind of situation. You're telling me to look into a crystal ball and come up with a number.
Yeah.
I don't think any analyst worth their salts will be able to do that. It's a supply and demand market. What we look at are the fundamentals of the underlying issues that are facing the economy and will cause a Cedi decline. At the moment, they are not looking good. So what I would say is that there's a potential slide on the market. We are likely to see the Cedi weaken further. However, if the inflows are able to kick in, it will stem the slide. But largely, we are an import-dependent economy. We have a lot of inflation that we are importing into the country already. Until the situation, external factors improve, or our supply side improve locally, we are going to have to battle this kind of situation. It will be difficult for me to pull a number to this.
All right, we'll leave it there. Head of Client Coverage at IC Group, Derek Mensah, happy to have spoken with you this afternoon. You're watching The Marketplace. When we come back from this break, Patrick Agama is on standby to talk the latest happenings on the money market, so don't go anywhere. And welcome back to The Marketplace. Government hit by a series of negative assessments. First, S&P downgrades credit readiness to a junk status, and then Africa's biggest bank, Standard Bank, slashes our growth rate from 6.2% to 3.1%. And these things have a tendency of impacting the market. Joining us is Head of Trading at Republic Securities, Patrick Agama, to analyze the impact of this on the markets plus other news he has been monitoring for us. And so welcome to The Marketplace, Patrick. We've been talking a lot about the S&P downgrade. How do we expect that to impact the markets? How soon can we tell?
Good afternoon, Daryl. So what we are saying is that investors have constantly been reducing their exposure to this country, Ghana. So we know that they are expecting this to happen, or they've been seeing and studying the trend for some time. So that has already been in the market, and we expect to see what the government will do to respond to this, and that's what will affect the market going forward. We can also see that the reliance on the discussion with IMF can play here, because the calls we are getting from investors is showing clearly there's a level of speculation on the market now. As you can see, rates inching up little by little.
Okay, we'll be watching that to see how the markets react, but also reacting are investors to the half-year results released by listed companies on the Ghana Stock Exchange. We expect some sort of buzz on the market when the half-year results are released. Tell us what the expectations are.
Well, so what we've seen last week is that we saw movement in about 6 equities and also the exchange-traded fund. When you see a lot of activity this way on the market, it should tell you something is happening. We saw that some 4 equities drove the market down, and despite the improvement in their financials and all that, it's not enough to withstand the selling pressure on the market. We saw companies like MTN dropping as low as 75 pesos and then moving back to 80 pesos per share. So we expect this level of activity on the market for some time until we get some confidence that these financials or earnings reports will drive investors towards buying some of these stocks.
Well, but earlier you were telling me that, I mean, it's difficult to really point to the release of the half-year results as what is causing the buzz we're seeing on the markets right now. So what other factors could be at play?
You know, there is a lot happening now in the economy with regards to even this rating coming in. So there also the pressure we are getting from the fixed income market, where rates are going up. People are even neglecting the secondary market and just relying on the primary issuances that we are getting. So that is what's happening. We can see that there's so many things happening at the same time affecting the markets. So we expect to study more and see where we can draw the lines clearly.
And let's quickly touch on the Treasury bills auction. Oversubscription recorded again last week by a rate of 112%. But the volumes traded have decreased week on week. Tell us more.
Well, the volumes traded from the secondary market point of view decreased significantly by 35%. This is because investors are drawing closer to the primary issuance, and that is keeping the rates go up significantly. For the 91-day Treasury bill, it's cleared at 27.04%, inching up by 32 basis points. We saw the 182-day Treasury bill also moving up by 25 basis points to clear at 28.5. The 364-day also went up by 53 basis points to clear at 28.4. And if you look at the percentage of the bids accepted, largely investors are still demanding for the shorter tenors because they expect interest rate to reprice in the short term. So you see that 73.3% of bids accepted went in for the 91-day Treasury bill against 17.9% for 182-day and 8.8% for the 365-day bill. So we can expect the subscription rates to be rising in every issuance in the days to come.
All right, Patrick, grateful you could join us. Thanks so much. Have a great week. And that's the marketplace, everybody. More news on our website, myjoyonline.com/business. You can read more about the S&P downgrade and government's reaction to that, as well as a news we brought to you about Standard Bank slashing our growth rate to 3.1%. That's on myjoyonline.com/business. My name is Daryl. Kwawu. Thanks for watching. Goodbye.